At 9:30 a.m. this morning, a phone rang inside one of the most powerful financial institutions on Earth. Not a press call, not a rumor, a demand. On the other end of the line was a clearinghouse asking for money, real money right now. This was supposed to be routine, a wire transfer, a formality, the kind of thing that happens every day and never makes the news. But today, the wire didn't come. Minutes passed, then more. Inside the system, alarms began to sound without making a sound at all. Because when money stops moving, everything else does too. This was the moment the game stopped. Margin calls aren't scandals, they're housekeeping. The financial equivalent of taking out the trash. Every single day, banks, hedge funds, and trading desks get tapped on the shoulder and reminded to top up their accounts. It's routine, automatic. So ordinary that it rarely earns a second glance. Money moves, screens refresh, numbers rebalance, and the system keeps breathing. Nobody outside the trading floor ever hears about it, because they're not supposed to. That's how this machine is designed to work. Quietly, smoothly, without friction, without headlines, especially for the biggest players, especially for institutions so large, so embedded, that hesitation isn't even part of the equation. When the call comes, the wire goes out. No drama, no delay, that's the unwritten rule. And it has always held. Until today, because this morning the request was made just like every other day. Same process, same expectations, same assumption that the money would arrive before anyone needed to ask twice. But this time, nothing happened. No confirmation screen. No transfer notice. No back office follow-up. Just an empty response where certainty used to live. At first, that kind of delay doesn't trigger panic. It triggers confusion. A technical check. A quick assumption that someone, somewhere, is resolving it. But as seconds stretch into minutes, routine starts to feel unfamiliar. And in finance, unfamiliar is dangerous. Because the system isn't built for waiting, it's built on immediate compliance. On the belief that when the bill comes due, it's paid without question. And today, for the first time, it wasn't. So why didn't it this time? After the request went unanswered, the clock kept moving. Screens stayed lit, trades kept printing. On the surface, everything looked normal. The market was still open. Prices were still updating. Orders were still flowing through the pipes. But underneath that motion, something fundamental had shifted. A delay had appeared where none was supposed to exist. On trading floors, people stopped talking and started watching. Conversations died mid-sentence. Eyes stayed fixed on monitors a second longer than usual. Phones stayed closer to hands. Not to make calls, but to be ready for them. Whispers replaced certainty. Quiet checks were made with back offices and clearing desks. No one announced a problem. No one needed to. In finance, noise means activity. Noise means trades, calls, explanations, reassurance. Silence means danger. Because silence usually means someone, somewhere, is trying to buy time they don't have. And time is the one thing markets don't forgive. By 10 a.m., the absence was noticeable. By 10:30, it was uncomfortable. The longer the gap stretched, the heavier it felt. Traders began doing what they always do in these moments, watching other traders, looking for tells, reading pauses, measuring the mood instead of the price. By 11:08 a.m., the room had changed. The question was no longer whether something was wrong. That answer was already clear. The only question left was scale. How deep, how exposed, and how far the damage would travel once the silence finally broke. In markets, silence screams. To understand why that silence mattered, you need to understand what a margin call really is. Strip away the jargon and it's simple. It's borrowed money and a safety buffer. You put down a deposit, you borrow the rest, and you're allowed to play a bigger game than your cash alone would permit. As long as prices behave, no one asks questions. But when prices move too fast, that safety cushion shrinks. And when it disappears, the exchange doesn't want explanations or future promises. It wants cash. Right now, assets don't count. Reputation doesn't count. Only cash does. And JP Morgan didn't have the cash. For more than 100 years, this institution was treated like a financial fortress. Through wars, crises, and crises, it stood as the symbol of permanence. Money could fail elsewhere, but not here. That belief was baked into the system. But fortresses don't collapse from the outside first. They fail when pressure builds quietly within the walls. This missed payment wasn't a clerical error or a bad day. It was a crack small, but visible. And once a crack appears, confidence starts leaking out fast. What if the strongest bank isn't strong at all? Banks don't actually keep mountains of cash waiting for a crisis. They keep confidence. They hold long-term assets, complex instruments, and promises that only work as long as no one asks for everything at once. That's the trap. On paper, balance sheets look massive. In reality, liquidity is thin. When stress hits, assets can't be sold fast enough without collapsing in value, and during a liquidity event, time disappears. In a fire, you don't negotiate over the furniture. You look for the exit. In a fire, paper wealth burns first. Once the payment window closes, the rules change. Control shifts. The exchange doesn't wait for explanations, press releases, or rescue plans. It doesn't care who you are or how big you've been. The process becomes mechanical, automatic, cold. Positions are seized and unwound not by people, but by code. Algorithms execute orders without emotion, without hesitation, and without regard for price. They don't ask whether the timing is fair or the impact is survivable. They only follow instructions written long before the crisis began. The machines just turned on. That's when silver entered the story. Not because it was special, but because it was exposed. For years, the market had been leaning on it, shorting it, compressing it, betting that it would stay quiet forever. Small moves were manageable. Big moves were not. When the price began to rise, it didn't just hurt. It forced action. Losses grew faster than anyone expected, and positions that once looked controlled suddenly became traps. Someone, somewhere, no longer had a choice. They had to buy. Someone was forced to buy. Modern finance is built like a spider web. Thin strands stretched across the globe, all connected, all under tension. Every major institution is someone else's counterparty. Every promise depends on another promise holding. When one node fails, the stress doesn't stay contained. It jumps. Payments get delayed. Obligations get questioned. And suddenly, everyone starts asking the same quiet, terrifying question: who's next? Because in a system this interconnected, there are no isolated failures. And JP Morgan isn't alone. Markets have seen this movie before. The names change, the years change, but the pattern doesn't. It always begins with reassurance. Officials say the problem is contained. Analysts call it technical. Commentators urge calm. Then come the closed-door meetings. Emergency liquidity. Carefully chosen words meant to slow panic, not explain reality. We've been here. And the last time this script played out, it ended faster than anyone expected. What was framed as a single institution became a global event almost overnight. We've heard these words before. When trust breaks, the system doesn't fail loudly. It freezes. Banks stop lending not because they want to, but because they have to. Every loan becomes a risk. Every counterparty becomes a question mark. Credit, the invisible fuel of the economy, stops flowing. Businesses can't roll debt. Payrolls get delayed. Projects stall. This is how financial stress escapes trading screens and enters real life. Not through collapse, but through hesitation. This is where recessions are born. That's when the real decisions get made. Not in public, not on television, in quiet rooms, behind closed doors, far from trading floors and headlines, meetings that aren't on calendars, calls that aren't recorded. When these gatherings happen, it's never about whether there's a problem. It's about how much damage can still be controlled. Markets may not hear the words, but they feel the consequences almost instantly. Volatility rises, liquidity thins. Someone, somewhere, is weighing outcomes that will affect millions. Someone is deciding the price of survival. At that point, the system faces a choice it never likes to explain. On the surface, it's called stability. In reality, it's a transfer. A bailout uses printed money to keep institutions alive. A bail-in uses deposits. Savings are reclassified. Accounts become tools. What people think of as cash turns into something else without their permission. It's legal, it's procedural, and most people only learn it exists when it's already happening. This isn't theory. It's a mechanism that's been tested before when promises mattered less than survival. Your money isn't as safe as you think. That's why the coverage sounds almost soothing. Words are chosen carefully, sharp edges are sanded down, a missed payment becomes a delay, a default becomes a technical issue. The goal isn't to inform you of risk, it's to keep you from reacting to it. Calm language buys time. Time keeps doors open. But the most important information is often hidden in what isn't said at all. Listen to what they're not saying. Markets don't fall all at once because people panic. They fall because someone is forced to sell. When margin is called elsewhere, assets get liquidated everywhere. Stocks become a source of cash, not conviction. Liquidity dries up, bids disappear, and prices gap lower with no resistance. What looks like fear is often mechanics at work rules being enforced in a system running out of flexibility. And once that process starts, it rarely stops on its own. The selling isn't done, because the real cost doesn't land on balance sheets. It lands on people, on pensions that depend on uninterrupted credit, on companies that rely on overnight financing to make payroll, on workers who never placed a trade but are tied to a system that did. This isn't abstract finance anymore. It's grocery money, rent, retirement checks. When financial plumbing breaks, the damage flows outward, far beyond the institutions that caused it. This is where it becomes personal. When trust in promises breaks, people don't invent new behaviors, they return to old ones. History shows the same reflex every time confidence in institutions falters. Capital moves away from claims and toward things that stand on their own. Assets that don't rely on a signature, a server, or a third party's solvency. This isn't ideology, it's instinct. When rules change overnight, people choose what can't be rewritten by committee. The old rules are fading. From here, the path splits. One route is intervention liquidity injected, rules bent, markets stabilized just long enough to breathe. Another is restructuring, where losses are acknowledged and spread unevenly. The third is slower and quieter. Prolonged instability, where nothing fully breaks, but nothing truly works either. History suggests the outcome is rarely clean. Each option buys time, and each one carries a cost that shows up later, somewhere else. The next headline decides everything. This is why moments like this don't come with sirens. They don't announce themselves as emergencies. Financial history doesn't shout first, it whispers. The warning signs appear small, technical, easy to dismiss until they're not. By the time panic becomes obvious, the exits are already crowded. This isn't about fear, it's about recognition. About understanding that systems don't fail suddenly. They signal, quietly, patiently, and only once. This was the whisper. The system didn't collapse today. It revealed itself. It showed where the pressure points are, who carries the risk, and how thin the margin for error has become. Nothing you've seen changes the past, but it does change what comes next. Because once you understand how fragile confidence really is, you stop taking stability for granted. You start paying attention to signals instead of slogans. This story isn't finished. It's unfolding in real time. Stay alert. Stay informed. This story isn't over.